Welcome to The Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is Friday, June 9th, 2023. S&P 500 currently sitting at 4303. I'm David Zarling. I'm here with Coach Kevin Ferrari and David Dean's List Yoakum. It feels weird saying 4,300.
We're here.
Yeah, here we are. Feet firmly planted at a price level we haven't seen since August of 2022 on the S&P 500. And that means we're approximately 20% off the lows from October. Bear market's over, right? I feel like the headlines saying that the bear market is over just because of a 20% rally. I'm going to challenge it just because if you're a market historian, you look back at 20% rallies, that doesn't necessarily mean bear market's over. But I'm not here to say that the bear market continues. I definitely think above 4180, where sellers have shown up in the past, getting past that is huge. But Kevin, like we were talking before hopping on here, I suppose they got to pick a number.
Yeah, right. Because, I mean, the way I think about it, which I'll preface this by saying people are going to argue about something regardless, but I mean, without having a specific number to reference, I guess, right? I don't know that you would ever consider a bear market or bull market over when it starts. I mean, it would just be probably a little bit more of a classification mess than it is now. I mean, you got to throw it in a bucket somewhere, right?
Well, I think, is it fair that this is what maybe a non-technician would use? A nice round number?
Sure.
If you don't use charts and you can't identify higher highs and higher lows, or lower highs and lower lows, or a rising 200-day or a falling 200-day, if you don't have those tools, you got to pick some numbers. I mean, 20% sounds nice. It's a lot easier to remember than 19.97.
You know, because I don't actually know this. Like, who actually decided that? Like, when did that become a thing?
I don't know.
Like, do we even know that? Or is it just kind of slowly become consensus?
Yeah, it's kind of like, and the inverse is what the media focuses on too. If the market is down 20%, that's a bear market.
Mm-hmm. Which we talked about in the Lunch and Learn. What was it, the most recent or the time before, right? There was, I'm not good with dates. But
2011.
Yeah, what was it, 19.8 or something like that based off the close.
Yep.
Like if you went intraday, you were at 20%. If you took the max intraday drawdown, but the close was just before that mark, which, I mean, if you get to split hairs like that, that's close enough to me. I don't know about you.
Oh, absolutely. If they call a strike and that ball is just touching that black part of the plate, it's a strike. Strike. Not here to argue with the umpire. Yeah. I mean, it can be fun sometimes.
All right.
Especially if the umpire is cool. But, you know, in the bear market of 2000 to 2002, 2003, we had a rally that was 24%, and the bear market wasn't over. We had same type of situation in November of 08 to January of 09, up about 24%. Bear market wasn't over. I'm not bringing those things up to say that I think the bear market continues here. The market doesn't actually really care what I think. I don't know if you guys know this, but the market has never asked my opinion. Has the market ever reached out to you and said, hey, what do you think?
No, I keep hearing about those advisor surveys. I don't think, how do you get one of those? How does that work?
Oh, that's a good point.
But yeah, that's not the market asking though, right? I don't even.
No.
Yeah. We do. The market should have an umpire. It's like baseball. There should be one person or like a crew of three that have to forcibly call this, and everybody has to agree to it.
And then do we go to New York?
You could. And then what happens if you get ejected from the market? How does that work?
Oh, man.
Like, what do you sit a day or something? I don't know.
Yeah, is it 1 day suspension?
We might have to work something out.
I don't know. David, has the market ever knocked on your door?
No, it showed up in my dreams a few times to let me know where it's going, but that was a state of dreams.
That's probably worth a campfire discussion, because in Market Wizards, that book on guys who are actually like really good at managing money, many of them using technical analysis. I can't remember the individual, he talked about how when he was in sync with the market, he would have dreams about it. And it was kind of a fascinating back and forth between Lewis and this individual. Wish I could remember what it was, but here we are, 20% off the lows. For whatever reason, the media decides that that's the end of a bear market. We're not here to tell you whether it's the end, but if we're making higher highs and higher lows, we know we have an uptrend, and we've broken a prior rate of trend that was down. If you connected the highs from January 22, March of 22, August of 22, November of 22, if you were to take the highs in the S&P 500 and draw a line across those, we've broken that. And we're now sitting at a weekly. Now we have a few hours here till close. But if we were to close around this level on something like S&P 500 cash, we would be recording above the high from August of 22. And so all signs from a price perspective point towards buyers having control or demand having control, right? Because it's all law of supply and demand, which isn't sexy. I get it. Like talking about demand having outpaced supply isn't as exciting as saying soft landing, hard landing, interest rate, this or that. But it is what it is. If you're above a prior level sellers had shown up at before, that's good information. So we've lamented a little bit here about a definition, a round number, because humans love round numbers. That's why I tell people I'm 6 feet tall when I'm really like, I don't know what it is, 5'10 3/4, or if I stand on something like 5'11.
Yeah, it sounds like you're stretching that a little bit, but yeah.
When you put it in the college or high school program,
man.
yeah, right.
I
You know
think
what
I
I'm
was
talking
like
about.
6'3", 285,
Yeah.
and like all of 5'9", if I'm lucky, 185 pounds at that point. So yeah.
Right. In the college and high school program, I know I had inches added, and I didn't even have to ask for it. Coach just did it for me. Kind of wild. But what are we seeing from, in the last 2 weeks? I know on this podcast, we talked about market health and a narrowing market. So a certain amount of stocks, and that's also a topic du jour. Like that's a topic that even some of the technical community had focused on, is what are the top, 10 stocks doing? And we highlighted that, I think it was 2 podcasts ago, maybe 3, that the top 10 stocks in the S&P were responsible for 95% of the return year to date, which is an extreme number. It was an extreme number. It's a number that hadn't been seen for many, many, many years. That didn't mean that couldn't continue, but have we seen that continue? What are you guys seeing from a participation or breadth standpoint?
I'd say earlier this week on Wednesday was a big day. We saw, if you're looking at something like IWM or Russell 2000, had a lot of volume coming up, breaking through some of those March and April highs. From a breadth standpoint, on Wednesday, it was probably the best breadth we have seen in a long time. Being, just to give some context, the universe we scan for internally is we're looking for stocks above 300 million in market cap and excluding OTC stocks. So our universe comprises of around 3,900 individual stocks. And when we're looking at something like 40-day absolute highs, we had 854 on Wednesday. So 854 of those 3,900 were making 40-day absolute highs. And then on the flip side of that, the amount making lows was 42.
Wow.
So it wasn't even comparable. Definitely the best breadth we've seen, especially since I've started working here the last couple months. So seeing some of this rotation into those smaller caps, seeing more names participating, and also the volume following that. So
yeah, so breadth expansion, and interestingly enough, that 854 number out of 3,900 is approximately 20%. So maybe that's a more important 20% than being off the lows 20%. And your point is, it's one of the bigger numbers we've seen of participation of the upside looking back 40 days that we've seen in quite some while. And just as importantly, the amount that aren't participating to the downside, that's also important. That's huge. And I think you brought up small caps as a potential thing that you could look at as a proxy for breadth, clearing this 180 level on IWM, important. And then what day was that, you said, David, for? Wednesday. I would argue that Tuesday also saw pretty strong breadth. So you had a 2-day advance that saw many stocks participating the upside. That's a good thing. Like if you want to see a bull market move higher, you want to see that rotation more broadly than just a narrow top 10 stocks.
And I'd say for some more context, to start the week, on Monday, we had 317 making absolute highs. Going into Tuesday, we had 691. Wednesday was 854. And then yesterday was 426. We have yet to run the numbers today. But if you compare that something back to around late April, we had the 26th, we had 76 stocks making 40 absolute highs. So
yeah,
seeing a lot more participation from the broader market.
It's good to see the guys come off the bench and play the game. This is good. We did come off of a period, when you look at, and I know we've covered this several times, but it's important to, sometimes you got to say things 7 times for them to stick. But January of this year was an important period of time from a breadth standpoint because you saw a Whaley breadth thrust, you saw breakaway momentum, you saw a Zwig breadth thrust, which is also some call 70. So you had all 3 of those in January. You had a rug pull in breadth in February and March, which was narrative defined with the banking issue. One of the largest moves we've seen out of financials in 10 days back in the beginning of March. But we've now seen small caps, financials stabilize and move higher out of here. And this is following, last week, a good technician that we're aware of, David Cox, he highlighted that if you looked at the relationship of the NASDAQ 100 and the S&P 500, you compared those two, it had the largest 10-day relative move, which was about 7% since March 10th of 2009, which if you're a bona fide market historian, March 10th, 2009 wasn't a top, was almost the exact bottom of that bear market and the beginning of a new pretty big advance. And so you have 2 different metrics, one being defined by a relationship in the advance of growth in tech versus the S&P, and the other by this broadening out that we're seeing now. The evidence continues to stack up for the ongoing advancement of stocks. What else? Is there further evidence that we're seeing?
Kind of talking domestically, I guess, but really participation to it almost seems like it's broadening internationally as well.
Okay.
So I know kind of before, right, we're kind of focusing on, well, depending on how far back you go, more towards like the beginning of this year was kind of Europe, and then kind of transitioning more recently to like Japan. I know in like Mexico we've talked about being pretty strong, but now you're seeing countries like Argentina, maybe just even Latin America as a whole, really start to perk up.
And isn't that fascinating, Kevin? If you think about Latin America and its currency sensitivity to the dollar, right? That Latin America would be doing this with the dollar moving higher since the beginning of May. That's important information, right? If you're seeing Argentina, I think you said Mexico, just Latin America in general, showing that type of strength, I think that's important information.
Yeah, for sure. And even like Greece was one that was looking pretty strong. And I think Turkey, too, was kind of rebounding a little bit. I mean, not necessarily looking as good as it was before, but, and I mean, you mentioned the dollar. If you look at that kind of big picture, kind of this 104 area on DXY, if you go back, has been kind of a, pretty important inflection point, I guess, on both sides. I guess really, if the dollar pauses here and rolls over, I guess you can't really be too shocked about it. Maybe this is just kind of foreshadowing that might be the case.
Yeah. And you're talking about this, 102 to 104 area that had been a place of selling in January 2017, March of 2020, and even going back far as 1989, it was an important inflection point that if we were to break lower out of here, I think what you're saying is the strength that you're seeing out of some of these international equities that are dollar sensitive. If you saw a trade weighted dollar fall from here, that wouldn't be surprising.
Yeah, it wouldn't shock me. No, yeah, for sure.
That makes sense. So some areas of international doing well, not all. And we can either touch base on that now, or we can continue down the route of what we're seeing out of, it could be New York Stock Exchange advanced decline. We could talk about commodities. We could talk about some of the big cap names like Apple and Microsoft, or touch base on IWM. This is really your guys' show. Where do you guys want to take this next?
I'd say kind of going back to some of the breadth, as you mentioned, New York Stock Exchange, advanced decline. We saw the largest advance day relative to declines since February for New York Stock Exchange. Now, NASDAQ slightly trailed. I believe the number was 98 last I checked for yesterday or the day before. So we're seeing more New York Stock Exchange names propping up. Now, a big part of the Russell 2000 as well as regional banks. Regional banks have taken back their quote unquote crisis lows back in March. They've taken back those. We also see names like Tesla, which has just tied its longest daily winning streak in its history at 11 days in a row. We have another name like Carvana, up 50% the other day. ARK is doing well. All these speculative and more risky names are propping up, and the advanced decline for New York Stock Exchange is also confirming that. So definitely seeing some risk come back into the market. And with that, we're above 4180 on the S&P. So despite unemployment numbers, despite inflation, despite whatever anyone else might cite for macros, everything in the short term is pointing upwards in terms of breadth and risk. So
no, it's a good point because you don't really hear us talking about hard landing, soft landing. Kevin, I can't remember how you phrased it before we hopped on here regarding recession, but it's not really something we don't use really narratives to manage risk and reward. So with that, you mentioned Tesla, longest winning streak, 11 days, and you mentioned Carvana. These were names that were kind of beaten down pretty hard, and mentioning the risk on type behavior in things like ARK. I think of online retail. I believe discretionary is one of the best sectors this week. When you think about risk on versus risk off, are there things that you guys are looking at relationship wise? Like there's certain sectors that when you see them do well and other areas don't, you're like, okay, that's a little bit risk off. This week, however, we would make the argument based on what we saw at the sector level, pretty much risk on behavior. So can you walk through some of those relationships? And I'll let you guys take it from here as far as what relationships you want to cover.
I'll cover one briefly and I'll let Kevin take it from there. This week, the best performing sector was consumer discretionary. And what do you know? The worst performing sector was consumer staples. So it's kind of along with the theme that we've seen recently of utilities, energy, some of the more defensive sectors really underperforming. And we've seen that all of 2023. But the beginning of 2023 was really the shift to tech, risk, and some other names. So what we're seeing in a relationship wise, we're seeing the risky names outperforming the defensive names, and even some of these defensive names being negative, especially when we're talking about this week.
Sure.
Yeah, I'd say like utilities or as another sector, I think that usually kind of lump in with staples. I mean, it's technically positive this week, but it's not like it's necessarily making any headway, to where I guess that would be kind of conflicting with some other sectors. I guess like your transportation areas, not necessarily seeing anything crazy there, especially if you think like your railways and things like that, like Union Pacific. Just kind of hanging out, not really moving anywhere.
That's an important distinction. Not moving anywhere is different than saying moving lower.
Right.
So,
yeah. They haven't really broken down. They're just kind of, hanging out with the boys, having a couple beers, not planning on doing anything, I guess.
Yeah, they haven't, yeah, Union Pacific hasn't done anything since March.
Yeah, it's been a while.
Yeah, it's just hanging loose. And sometimes it's like that. But I think that's a great example because Union Pacific, some would argue cyclical, important transportation area. And Kevin's point is not that because Union Pacific hasn't done anything, that's bad. It's more, if you don't see Union Pacific breaking to the downside, that's good. From a risk on, if you're in a risk on scenario, you're placing your allocation towards reward and managing risk. You want to see transportation areas hold up. I think similarly, like semiconductors, because pretty big, 2 large weeks in a row in May to be consolidating like this. up against price levels that go back to November of 21 using something like SMH measuring semiconductors. That's really quality information to see. I'm going to lead you guys down when we look at top 10 names in the market, 2 of them would be Apple and Microsoft. Semiconductors kind of fall in the same level, meaning they're right up against levels that are important going back to what had been the peak of the previous bull market. And here we are in both of those names, plus semiconductors. It would be really, really quality market behavior to just consolidate in this area for a while, using something like SMH in the 150 level, Apple, the 182 level, Microsoft, 337. If you were just to hold these levels for a while and then move higher, that would be extremely quality. At the same time, Kevin, I know you mentioned we always have to be asked the question, is this where you want to be putting new money to work? Is this where you want to be buying Apple stock? And is this where you want to be buying Microsoft stock? These aren't recommendations. Everybody listening to this is an adult. But can you walk through why we would ask that question, Kevin?
Yeah, so if you think, you referenced Apple and Microsoft. Specifically, if you look at those on an individual basis, they're coming up against essentially, more so Apple and Microsoft, all-time highs where they're kind of seeing a little bit of resistance. Microsoft didn't quite get there, but it had kind of a similar look. And even if you think broad tech or NASDAQ, if you kind of look to the left, they're kind of at some areas where you can't be too surprised to see, a little bit of supply overhead. So really, if you think from like a risk reward perspective, it would be pretty uncomfortable to be putting new money to work here where you're kind of further away from, I guess, some more logical concrete stops than you would be, if you put money to work in these areas earlier.
Got you. So you're saying something like a NASDAQ 100 to put new money to work here. And again, this isn't a recommendation one way or the other. You're just saying you have to ask that question and then say, how are you going to manage risk here? If you're going to put money to work in the NASDAQ 100, really hard at this point. Not that it needs to roll over and be bad. It's just, what's your reward for doing so when you're up against levels where sellers have shown up in the past?
Yeah, and really, because this kind of can build up a couple different points, I guess we talked about before. So a couple ways to look at it. If you think of what we were talking about before with kind of more your flight to safety sectors like staples, utilities, things like that, we were talking about they're not necessarily breaking down. They're more kind of holding steady. I think it helps too if you look at like relative relationships of those sectors, like the S&P, where they are on like a relative basis breaking down. So I think it just kind of accentuates the point that you're not seeing any outperformance from those areas. Maybe even though that they're not breaking down absolutely, it's not like they're outperforming some other areas of the market like tech, like we've been talking about, things like that. So I think that's kind of another good way to look at it. I think kind of helps a little bit more confirmation. Because if you're seeing some of those areas or maybe some of the bigger stocks in those areas kind of show some strong performance, relative to more growth areas or the S&P, it would probably raise some more questions. That's then too, kind of we're talking about the whole tech to small caps area. That relative relationship, has been really interesting. If you look at that on a kind of longer term time frame.
Are you using QQQ or are you using like XLK? Okay.
Yep. So I use Qs for that, just for IWM. Well, actually, to look at it, IWM 2Qs, basically testing kind of all-time lows in that relationship. Almost more like a failed breakdown scenario with maybe like a retest, which is kind of an interesting scenario with what we're talking about with increased breadth.
Paint that picture more fully. The level that Kevin is talking about in small caps using IWM versus NASDAQ 100 using QQQ is an important level that goes back all the way to August of 2000, which was, people know, or many investors know, as a tech peak. And we've broken below that. We've seen small caps rally the last 2 weeks in that relationship. You could also make the argument that that was one quick bit of rotation. What do we see going forward? Was it that a false breakdown and we see small caps lead from here? We have some obvious levels that we can look at in the relationship, like IWM QQQ, that 0.5336. I know that's not a round number like 20%, but 0.5336, you're back above that. It's game on for small caps. Whereas, do you see this relationship? It was just a retest and it continues where you're seeing the big cap names lead. There's no right or wrong, but by using ratio charts and relationships, we can identify who has that leadership or the likelihood of ongoing leadership. So good point there. How about on a equal weight versus cap weight basis when we look at the market? What are you guys seeing out of that?
If you use a ratio like SPX divided by RSP, which is going to be your cap weighted versus your equal weighted, we're at some pretty important levels that we saw back in 2020, marking the lows for that relationship. Same thing applies to December of 2021, marking the highs of S&P versus RSP. So we have seen in the last week some of that rotation into the equal weights rather than, your star players being Apple, Microsoft, NVIDIA. Now we're still right at that level, so it's definitely an area to keep an eye on. It's too close to really have opinion on it. My chart's showing it's actually directly within that range, so hopefully we can kind of get some more details of that in the next week or two. But definitely good to finally see some of the equal weights outperforming these cap weighted. To give an analogy to sports, it kind of reminds me of LeBron James getting tired after a huge year and he needs some time management. These teams are looking towards some of the smaller players to step up and fill that void. So
yeah, it'd be nice to see that. Like you said, we've seen flashes of that, the players off the bench coming and helping this week. It'd be great to see that continue. It doesn't have to, but your point is extremely valid that seeing equal weight outpace cap weight is a healthy breadth dynamic, and we want to see that continue.
Yeah, actually, I think if you look at that, relationships like NDXE would be NASDAQ 100 equal weighted to NDX, so NASDAQ 100 itself. And you think that is kind of it just has more of an extreme look when you look at that chart to where that relationship there is basically sitting right around, if not just a hair below all-time lows.
Yeah, for sure. That relationship's worth tracking going forward. You mentioned as the data comes in, being aware of what that means. That's that Bayesian inference, which is just a fancy way of saying we're going to give credence to the data that's coming in more recently. And if that relationship of equal weight NASDAQ versus cap weighted NASDAQ were to hold these lows, that would be further evidence that the cap weights have the ball and are going to carry the market higher. And that's perfectly fine. I mean, the market can do that. And then I guess the market would just continue to scream about this narrow market, which is fine. It's just a matter of how you manage that risk then and make sure that you're allocated directionally towards the areas that are going to carry the market. And there's no right or wrong. It can be small caps. It could be large caps. But as long as they're moving higher, that's the very definition of uptrend, regardless of the 20% definition or not. How about bonds? What are we seeing out of that area, like fixed income? We could even pivot to crypto, or if there's other things you guys are seeing out of currencies. I don't think we've touched base on commodities at all. What are you guys seeing out of those areas?
Well, from what I'm looking at, not really much at all. And actually, interestingly, because we're talking about relationships, if you look at bonds to stocks, so just like AGG to SPX, and that's actually kind of an interesting chart, kind of breaking down below all-time lows here recently, which is kind of interesting. But, I guess just bonds themselves in general, I guess haven't been seeing too much other than, I guess convertibles haven't been too bad, but I know we've kind of talked about this before, where those kind of seem a little more linked, to like a lot of your tech companies. So when techs are doing well, convertibles seem to hold up a little better when you look at like ICVT. So that might be, I guess, somewhat of an outlier, but I don't know if it's anything I'd want to participate in.
Right. And your point is just with something like AGG versus S&P, seeing that break to the downside is another piece of information towards risk on behavior, right? If the market wants to own stocks versus bonds, we want to pay attention to that. And a simple way to look at that is that relationship. So good point there. If we look at crypto or commodities, anything we're seeing out of those two areas before we wrap up the rest of this episode?
I'll touch on crypto real quick. Bitcoin, obviously everyone's been paying a lot of attention to that over the past few months. Back in early to mid-March, we had a pretty good run in Bitcoin. Now we find ourselves between a couple of key areas, one being below current price, if you're looking at Bitcoin versus USD, around 25,000 to 25,500. Those are a couple key support areas now. And then overhead, we have 29,000 to 30,000 being key resistance. So we're kind of stuck in between those two ranges. I would definitely feel better about it if we can get back over 30,000.
Mm-hmm.
And then if we get below 25,000, we have the 200-day moving average slightly below that. And then from there, you're not really going to see much potential support until around 20,000. So kind of just a sitting and watching game between two key levels. But I would definitely have a little bit more weight on that $28,000 to $30,000 level, which was the lows back in 2021 and 2020. So
want to see that hold. And even if you look at a relationship like BTC versus the S&P 500, right? Like, do we want to own crypto or want to own stocks? Definitely pausing right now below an important level. Let's call it the 7 level in the relationship. Does that continue? Don't know. We've broken a rate of trend in the relationship that goes back to November, which was an important bottom. Does that continue, or do we hold that? What I would equate to is that 20, like you said, that $25,000 to $28,000 level. Very important. How about commodities? How about anything in that area?
Yeah, not too much to write home about. I mean, if you look absolute basis on kind of like broad commodities, using like a BBC, kind of just hanging out, more so like bonds, kind of just flat. I would say they definitely look worse from a relative perspective to stocks. So it's not like broadly there's any areas there where I think you're going to get any outperformance or relative strength there. Individual basis, rice looks a little interesting.
Does it look rough?
I guess so.
Rough rice.
You need a magnifying glass to probably tell the difference there. Other than that, nothing really to write home about in the grains.
Sugar?
I don't even remember I know it's nice using, was that SGG?
Yeah, well,
that equivalent, but that's...
it's gone.
I know. It's a sad
it is.
state of affairs there.
The ETNs, the exchange traded notes, that, whether it was nickel or aluminum or sugar,
grains, like broad grains.
They took them away.
They're gone.
They're gone. There's 3 different events this week that how would you put this? You can't study the price on them from the standpoint of you had some ETNs taken away, which were your commodity ETNs, the ones we were just talking about. You also saw a change in the equal weight tickers from Invesco. Perfectly fine. It's just, and that doesn't have any significance other than they changed their tickers. And then Dorsey Wright is taking off some of its coverage of international areas. Dorsey Wright being a NASDAQ product now, and now not providing data on some of its international markets. I find that fascinating that we're losing some commodity ETNs and some of our international coverage. Do we look back 12 to 18 months from now and that was some type of sentiment at the time? The equal weight thing, that's neither here nor there. But the other two, losing out on really quality products that didn't issue K1s for our clients, it's too bad. I know we appreciate it. There's still some left. They're not by the same issuer.
Yeah, especially on the commodity side. Like if you're, I guess, sensitive to the tax side of it with waiting for the K1s, or if that doesn't matter to you, I mean, you still have, I can't think of the company now that has like corn.
Oh, Takirium.
Yep. We still have some products out there, but yeah, it was really nice not having to worry about those K1s.
For sure.
I mean, they're pretty broad coverage for the most part. It's fun when you see those things to be able to take advantage of it. Not so much anymore.
Yeah, it's too bad they took those away. But who am I? It is their product. They get to do what they want. I get it. Anything else as we bump up against the end of our time that you guys want to cover before we sign off?
It's kind of here nor there, but when you're kind of throwing out some of those names like Carvana and ARK and some of those things that got hit pretty hard. I don't know why, but I happened to look at Netflix, and that's actually looking pretty good here, kind of above that 408 roughly area.
Sure.
And man, just looking back at how hard that thing got hit, some pretty violent gaps.
The fact that it worked through the gap from April of last year, it has that same feel as Meta, right? Facebook, which is working through its gap from February of last year and created some of its own gap on its move higher. And a lot of it does have that feel of a short squeeze, meaning if you're short something and you have to cover, you're a buyer. And it wasn't that long ago that we were looking at I think it was a report from Yardini Research that had just epic amount of people shorting the market. This is what happens. The market moves against you, you have to cover. Could you see the market continue to move higher, technically speaking, because the short covering continues? Absolutely. It's a good point. Anything else? David, anything from you? Kevin? Either one, doesn't matter.
No, I would just say, looking at the S&P again, we're at another key level being those August highs of last year, but in the shorter term, we're making higher highs and higher lows. So no need to really overcomplicate what the market's doing right now. We see good breadth. We're over 4180, 4200 on the S&P. So price action over news.
Yeah, absolutely. Focus on the signal and avoid the noise. If we saw the S&P consolidate between this 4,300 level and 4,180, while uncomfortable in the near term, that would be super constructive from a market setting up for another move higher, especially considering next week we start to see we would be into an area where seasonality weakens for the summer in a pre-election year. Doesn't have to happen, but I know mid-June is, and moving into the end of June is typically weak. I don't think that would be a surprise by any means. So good point there. We're up against that August 22 high in the S&P. Consolidation would be perfectly normal, especially considering going back to what we were talking about previously with Microsoft, where it is at a horizontal level, Apple, where it is on a horizontal level, the Qs, where it is on a horizontal level, even things like TLT, 30-year treasuries, where it is on a horizontal level. This would be a perfectly normal place to see digestion and things move sideways for summer. Perfectly normal. Before we sign off, though, I want to let our listeners know that this podcast, The Weekly Trend, is brought to you by the Adaptive Select ETF. Adaptive Select is listed on the NYSE under ticker ADPV, helps investors access two of the most prevalent factors in markets, momentum and relative strength. Through proprietary identification methods, the Adaptive Select ETF attempts to own the strongest 25 large cap stocks when the market is in an uptrend. And since not all market environments are the same, Adaptive Select seeks to prevent extended declines by moving to short-term treasury bills and cash during long-term market downtrends. Investors can find out more, including how to invest in ADPV, by visiting adpvetf.com or calling 1-833-880-5200. As always, investing involves risk, including possible loss of principal. The ETF is distributed by Quasar Distributors, LLC. Gentlemen, great job today. Ian is out of town, heading to the Maryland. I appreciate your expertise and sharing. To those listening, we appreciate you guys as well. We ask you to share this episode, share it with your friends, give us a high ranking. That's one way to show appreciation for what we're doing, and it motivates us to continue to do these for you guys. Otherwise, thanks again, Kevin and David. Great job.
Thank you. Have a good weekend.
Have a good weekend.